Is the AI bubble real? It's the single most important question in markets right now. And depending on who you ask, you'll hear that we're either in 1999 all over again, or at the start of the biggest build-out since electricity. Both camps are loud. Both are confident. So today we're going to do something different. No cheerleading, no doom. We're going to put the bull case and the bear case side by side, weigh the actual evidence, and figure out what a disciplined investor should actually do about it. Here's why this isn't just an academic debate. A small handful of AI-linked names now drive a huge share of the entire market's returns. So if the bubble talk is right, the pain doesn't stay contained to tech. It hits index funds, retirement accounts, everything. And if the skeptics are wrong, sitting in cash out of fear could mean missing one of the defining trends of the decade. The stakes cut both ways. That's exactly why you need a framework instead of a gut reaction. Let's give the bears the floor first, because their strongest argument is simple math. By almost any historical measure, this market is expensive. The S&P 500 trades around 24 times forward earnings. The cyclically adjusted PE, the CAPE ratio, sits north of 40. That puts us in the top few percent of valuations ever recorded. High starting valuations don't tell you what happens next month. But history is pretty clear on this. The more you pay up front, the lower your returns tend to be over the following decade. You're not buying a bad story. You're paying a very full price for a good one. The second bear argument is about concentration. Market leadership is dangerously narrow. A few megacap names are carrying the index on their backs. When that few names matter that much, a stumble in any one of them ripples everywhere. And then there's the part that genuinely should give you pause. The money is starting to look circular. Chip makers invest in AI startups. Those startups turn around and spend that money buying chips. Cloud providers sign enormous deals with the same companies they're funding. When the customers, the suppliers, and the investors are increasingly the same handful of players, revenue can look stronger than the underlying demand really is. That's the kind of dynamic that, in hindsight, defined previous bubbles. Now flip it. The bulls have an argument that's just as hard to dismiss. Spending on AI infrastructure in 2026 is tracking somewhere around $660 to $690 billion. And critically, this isn't speculative money raised on a promise. It's being funded out of the cash flows of some of the most profitable companies on Earth. Data centers, chips, networking, and electrical power to run all of it. Compare that to the dot-com era, when the spending was funded by hype and debt against companies with no earnings. This time, the biggest spenders are printing real profits and choosing to reinvest them. That is a fundamentally different foundation. The second bull point, the revenue, is actually arriving. In a classic bubble, the fundamentals never catch up to the price. The story stays a story. But here, you've got real earnings growth, expanding margins, and enterprise customers paying real money for AI products that are already in production. Is some of the spending speculative? Absolutely. Will some projects be written off? Almost certainly. But some of this is overdone is a very different statement from all of this is fake. The picks and shovel suppliers, the companies selling the compute and the power, are booking that revenue today, not in some hope for future. So who's right? Here's the reframe that actually helps. The honest answer probably isn't bubble versus no bubble. It's, where are we in the cycle? Because even if AI is as transformative as the internet, remember that the internet was real, and the dot-com crash still wiped out 80% of the NASDAQ on the way to being right. The technology delivered. The early valuations did not. So the useful question isn't, is the AI bubble real? It's, is this 1995 with years of runway ahead, or 1999 with a reckoning just around the corner? And the uncomfortable truth is that nobody knows for certain, which is precisely why how you position matters more than which camp you join. So instead of predicting, watch the tells. Here's what would tell you the bears are winning. 1. The capex guidance gets cut, If the hyperscalers start walking back spending, the whole engine stalls. 2. The circular financing unwinds, and a marquee AI startup misses badly or can't raise. 3. Enterprise adoption plateaus. The revenue stops showing up, and the story has to carry the price alone. And 4. Credit gets tight because high rates make richly valued. Long duration bets the first thing to crack. You don't need to guess the top. You just need to know what you're watching for, so you're not the last one to react. So here's the synthesis, and it's the same discipline that survives every version of this debate. Both things can be true at once. AI can be a real, generational shift, and the stocks can still be priced for perfection in the short run. You don't resolve that by betting the farm in either direction. You resolve it by owning quality, sizing positions so a 30% drawdown doesn't break you, keeping some cash ready for the pullback the bears might be right about, and refusing to chase a vertical chart. Buy quality on weakness. Don't chase strength. It's not exciting, but boring and solvent beats brilliant and wiped out. So, is the AI bubble real? The most honest answer is, there are real bubble-like risks sitting on top of a genuinely real trend. The capex is funded, the revenue is arriving, and the valuations are stretched and the leadership is narrow. All of that is true at the same time. Your job isn't to win the argument at a dinner party. It's to stay positioned so that you're still standing whether this turns out to be 1,995 or 1999. Respect the risk. Don't lose the plot. And that's the analysis. Now, one important note before you go. Everything in this video is for education and information purposes only. It is not financial advice. I'm not your financial advisor. I don't know your personal situation, and every single buy and sell decision is yours and yours alone. Nothing here is a recommendation to buy or sell any security. The data and figures discussed are estimates and may be out of date by the time you watch this. So please, do your own research and manage your own risk. If this helped you think more clearly, hit subscribe and tell me in the comments. 1995 or a 1999? I read every one. Thanks for watching. I'll see you in the next one.